Greetings and thank you for joining us at FutureMoneyTrends.com. I'm here with Pamela Yellen. She's a New York Times best-selling author of Bank on Yourself, a safe and reliable alternative to just about anything that Wall Street is trying to sell you. She's been featured on ABC, NBC, CNN, and Fox. Currently, she's helping educate Americans through her website and her book, bankonyourself.com. Pamela, thank you so much for joining us.
Oh, it's my pleasure, Daniel.
Well, Pamela, I want to start off by saying since reading your book, it's truly changed my life. My wife and I have implemented this strategy in our own lives. And, for people who are just hearing this phrase, this strategy for the very first time, if you could take a few minutes here just to introduce the audience to what is Bank on Yourself and how did you come to its discovery in your own life?
Well, those are great questions. Let me start with how I came to the discovery of it. My husband and I have been investing and pension plans, the whole thing, retirement accounts, since 1987. And we just kept noticing year after year that we never seemed to come anywhere close to getting the kinds of returns that they kept telling us that we should be able to get. And we were doing all the things that we were taught to do, but it just wasn't happening for us. And so I have been a business building consultant to financial advisors for, I hate to say this, but almost 25 years now. And in that capacity, I've coached over 40,000 financial advisors now. And they kept sending me what they were coming across. And they would constantly come to me and say, Pamela, I found the holy grail of growing wealth. And they would always be trying to sell it to me, number one, but they also wanted me to get to understand it so that I could hopefully help them market it. And so I started researching all these strategies that these advisors were bringing me. And I ultimately investigated over 450 of them, and almost all of them turned out not to be even worth the paper they were printed on. Only a handful passed my due diligence, and I just kept searching and searching and searching. And then finally, it was around 2002, so 13 years ago, one of my clients, a financial advisor, came to me and said, Pamela, have you ever heard about this? And this turned out to be my mentor had written a book. That's Nelson Nash. He'd written a book called The Infinite Banking Concept, How to Become Your Own Banker. And I called up Nelson. I got a copy of the book, and that I decided after researching it and actually using this strategy in my own life that it beat everything that I had ever researched or come across before, and I decided to shift my entire business to helping the public understand what this Bank on Yourself strategy is and to help communicate that. And I'm an educator. I'm not a licensed advisor, so I wanted to make that clear.
Mm-hmm. When it's weird, when you learn about this, and it's almost like you have to keep reteaching it to yourself because it's kind of, I don't want to say a brain teaser, but it's so simple, yet there's so many thousands of things you can do with the policies. And for my audience, one of the big go ahead.
I was going to say we probably should explain what it is.
That's what I was going to go into. If for my audience, anyone who hasn't heard of it at all, what does it come down to?
Okay, the bottom line is the Bank on Yourself concept is based on an asset that's increased in value every single year for more than 160 years. It's never had a losing year, ever, not even during the Great Depression. And what it is it's a specially designed, supercharged form of dividend-paying whole life insurance. But as I point out in my book and on my website, bankonyourself.com, it is vastly different from the kind of whole life insurance policies that most financial gurus know about and talk about and love to hate. And they will constantly tell you that whole life is the worst place to put your money. I'm sure everybody listening to this has heard that. And they'll say that that's because the cash value grows too slowly and because the commissions are too high. And this type of whole life insurance, dividend paying whole life insurance, has riders or options added onto it that make the money in your plan, the cash value of your plan, grow significantly faster than the kinds of policies that Susie Orman and Dave Ramsey love to trash. They're talking about a completely different animal. And it slashes the commission paid to the advisor by 70%. And that money then is going to grow the policy owner's cash value a lot faster. And so the interesting thing is I just posted a blog post with a video where we took a look at a policy that had actually been issued in 1969. So we're not talking about nearly a half century ago. And back then, they didn't know about these riders. They didn't structure these plans with the riders that made the cash value grow faster. But I got to tell you, this was incredible. And anybody who wants to see it for themselves, just go to bankonyourself.com and click on blog, and they'll get to this post. But what we show is that you would have to get a 9.94% return in a tax-deferred 401k or IRA to equal the return of this plan issued 46 years ago. And the owner of this plan never lost a wink of sleep, never had to pick any stocks, never had to wonder and worry.
Now, how do these plans grow to where they have become literally safe and reliable for hundreds of years? Where does the dividend income come from?
Okay, that's a great question. And some people think that these insurance companies invest primarily in the stock market, and then they go, well, how can they earn those kinds of returns safely if they're investing in the same stuff that everybody else is? Well, they're not. The bulk of the investments are in investment grade fixed income investments. That's where the bulk of them is, and insurance companies are legally required to have sufficient reserves, cash reserves, to cover future claims. So they're not trading in and out of these, fixed income investments, and they are amazingly good at under-promising and over-delivering, because if it's not you are guaranteed to get a cash value increase. You're not guaranteed to get a dividend every year. However, these companies, and there's only about a handful of companies that have policies that have all the features that you need to maximize the power of this concept. But these companies have never missed paying a dividend for 160 years plus.
That's amazing. When it comes to like fixed assets in the world today, are these assets, these returns and the dividends, are they being affected by being in such a low rate interest rate environment?
They are. They are, and they are currently, the dividends are at historic lows today. So the thing is that when you get a plan, you get a proposal for one of these plans, one of these policies, they can only illustrate it, unlike, Wall Street, and they can show you, well, we got 8%, a few years, so we're going to show you what it would be like if you got 8%. They can't do that. Legally, they can only show you what it would look like, what your projections would look like, and your guarantees would look like if the dividend stayed where it is today, which, as I mentioned, is at historic lows. So when you see those and you go, well, this doesn't look as high as I maybe thought it would be, as interest rates go up, because dividends historically have followed interest rates. As interest rates go up, then your cash value growth and your dividends go up as well. And that's exactly what has happened historically, which is why I say, and I can say this absolutely, no hype involved, it is a wonderful anti-inflation, tool, because it follows inflation.
Okay, so that's a great question because or a great point because that's one of the biggest concerns, especially for my audience. Focused on, they're worried about the Federal Reserve, they're worried about the banking system in general. You know, a lot of people are still trying to pick up the pieces from the 2008 crisis. Stock market's recovered, but the economy hasn't done much recovery. You know, when it comes to inflation, how did these policies, how did the strategy, or how would it have worked? You know, going through a period of the 1970s or going forward if we had like a 10% inflation rate?
The dividends were again high interest, high dividends. And I've looked at my own policies and other policies going back for decades, and you can see that trend. You can see now. There is a bit of a time lag. Insurance companies don't turn on a dime. They are conservative by nature, especially the companies used for the bank on yourself concept. They're all owned by policy owners, not stockholders. And their whole reason for being is to benefit and to make sure that their policy owners' promises are met, unlike Wall Street, which is Wall Street's big thing is we need to have a good quarterly report for our stockholders. That's who they care about. And so that is exactly what has happened over time. There are times when the dividends have been 10%.
That's amazing that it's compounding like that, and it's in such a safe industry. Now, I noticed that it seems to be predominantly for Americans and Canadians to a lesser extent. You know, I have a friend in Israel who's looked into this, and I have some other friends in Europe, and these policies and this strategy is not available to people as much as it is to Americans. I want to know, why is that?
Well, I really can't answer that question. We've had our hands full with just educating people in the United States and Canada, and the laws in Canada and the plans and the tax laws and so on in Canada are different to some degree than the United States. And we've had people from other countries approach us and say, can you bring this to us? And we haven't done the research to find out exactly what the products are in the different countries and what the tax laws are and so on. What I tell people, and if you have listeners in another country, get my book. You can get it on Kindle, of course. Get my book, don't get the first book. The second book is the winner, because it really goes into details about the different riders and so on and how the tax laws affect it. The second one is called The Bank on Yourself Revolution: Fire Your Banker, Bypass Wall Street, and Take Control of Your Own Financial Future. And at bankonyourself.com in the upper right, you can click on it and buy it there for less than anywhere else, including Amazon. So just take the book or the Kindle to a really good life insurance agent in your country and let them take a look at it and see if something like this is available. It may be. I really can't say, exactly. I can't say because I haven't done that research because I'm so busy with just, U.S. Canada.
Now, there is a lot of misinformation that ties these strategies to like you were saying, the ones that David Ramsey and Susie Orman despise, and often, they get into these horrible discussions on the phone, and I'm curious to know if you'd had ever had a chance to speak with them directly about this, or do you know if anybody's ever had a chance to sit down and explain this? Because they're just screaming ignorance on the radio when they just trash these. Because the caller is just he's not you. The caller's not an expert. They're just somebody who's maybe read your book once, and they're trying to ask him a genuine question. And then these guys go in like a 5 to 10 minute rant about how much they hate them.
It's a rant, yeah.
So back to my question: have you ever got a chance to speak with them?
So here's the thing. Ever since I wrote my first book, I put out a challenge to Dave and Susie, that I would, or any of the other advisors, the gurus that believe the same bullcrap, that I would debate them anytime, anywhere, and that I can prove to them that this is a different policy than what they know about and that they're plain wrong. In fact, when I was writing my second book, I researched over 40 different major life insurance companies because I was trying to show an example of exactly how different the commissions and the cash values would be if you use the type of policy that they talk about. Now, they talk about a policy that doesn't pay dividends. So that means that the death benefit always stays level and you're not getting dividends. And this is what's amazing. Out of 40 major life insurance companies, there's not a single one that even offers this policy anymore. It's that outdated. So that's why I wrote my second book. Maybe Susie and Dave ought to update their talking points a little bit. They're talking about a policy that doesn't even exist anymore. That's how out of date they are. So I have challenged them to a debate, but here's what's interesting. I know for a fact they've been asked about it. And, in fact, they've been asked several times. They've asked Dave Ramsey about Bank on Yourself on his radio show, and they've written to him and her on their blogs and their websites. They are fully aware of this. But here's the reason why they won't step up to the plate. First of all, they're bigger names than I am. You know, they're the elephants, and I'm like the little mouse over there. They're just going, forget about her. We don't need to worry about her. And the other thing is, just think, if they actually looked into this and they saw how wrong they were, they would have to update everything. Their books, their talking points, their websites, everything they've ever said about life insurance, they would have to update it. Do you think they're going to do that? Do you think I would love to think that they would, but you and I know darn well they're not. They both made it. They're rich, Yeah. They don't need to deal with this.
Well, and their entire network is built on financial advisor doing mutual funds.
Exactly. I know. I do have a little blog post about Susie Orman not walking her talk, and she herself only has less than 5% of her money in the market, where she would tell someone who's like 50 years old in her book, she says you should have 70% in the market. But then when asked by the New York Times, so why don't you walk your talk? Why don't you own the same things that you tell your followers to own? And she says, well, I just really can't stomach the risk. And my thought is, really? But the little people, the rest of us, we should be able to do that. We should risk our money.
Yeah, and let's talk about mutual funds for a moment, because that is the big push, or it's not even. I would say the Bank on Yourself strategy is the alternative to that type of push, because that is what people are conditioned into believing that is the way to go with either 401k or investments. What percentage of mutual funds, Pamela, have underperformed the overall market or comparable indexes?
Well, it's 80%. 80% of all mutual funds and investment newsletters and advisory services and managers, money managers, all of them, 80% have underperformed the overall market and or the specific indexes that they track. And people don't realize that. And the reason is, it's not just the fees. It's not just the fees. In fact, that's the least of it. The most of it is the fact that they are human. They're just like the rest of us. They buy and sell at the wrong time.
Do you classify the Bank on Yourself strategy as savings or investment?
Well, legally, I can't call it an investment. And at first that really bothered me. I'm like, because this is a great investment. Beats any other investment that I know of. And then I got to thinking, well, really, when you look at the definition of investment versus savings, investment has inherent in it that you can lose some or all of your money, or even more than what you put into it, depending on what type of investment you're making. Whereas savings means safe and liquid. And so really this is truly not an investment strategy, because you don't have that risk. Now, you're not going to get 20% gains every year. That's not going to happen. It's not a get-rich-quick scheme. It is a get-rich slowly, steadily, and stop that ridiculous roller coaster ride. And here's the deal. The typical investor has now lost at least 40% of their savings, not once, but twice, just since the year 2000. Now, I hate to tell you, but that's only 15 years ago. Everyone listening to this right now, if I asked you, do you believe there will be another market crash in the next 5 to 10 years? I know that 99% of the people listening to this, based on my surveys of thousands and thousands of audiences, of people in my audiences, I know that 99% will say, I truly, with all my heart, no, there's going to be a market crash. And most of them think it's going to happen in less than 5 years. And the only thing we don't know is exactly how severe it will be or when it's going to take place. But we all do know it's happening.
Pamela, today, do you own any stocks or mutual funds? And if I could follow up with that is, for you don't have to base it off of yourself, but what should a person be dedicating to the bank on yourself strategy, income and savings wise?
Well, the reality is that you can tell people don't invest in I think 401ks and IRAs are some of the worst investment vehicles ever invented, and there's plenty of proof out there, and there's some great information on my websites about that. You're giving up over time 30% or more of your money to fees in those, if you're invested for the long haul, in those vehicles. And then, of course, if it's a tax-deferred vehicle, you're going to have to pay taxes, whereas a bank on yourself strategy is an after-tax strategy. You can access both your principal and gains with no taxes due under current tax law. But it's still, we're all brainwashed. And, most people figure that if their employer is blessing this and offering this and that it must be a good thing, and then they're going to tantalize them with that match in many cases. So the reality is a lot of people are going to have some investments in 401ks and IRAs. I can tell you there are a number of people who, the longer they use the bank on your strategy, the less they put in the market. Many of them stopped funding their 401ks and use that money to fund their bank on yourself plan. But, the reality is a lot of people are going to invest anyway. They're just going to do it because that's the way what we're taught to do. But I walk my talk. I have 5% of my net worth in things like mutual funds. And I do it more for laughs than anything else. I've never made any long-term money other than what I put in, which is what most people listening to this would find if they ever went and actually took out their statements and included what they contributed. They would find that all they have in there, if that, is what they put into it. And so, a lot of people do stop funding their 401ks and they direct that money in the bank on yourself. I stopped funding my pension plan 12 years ago and directed that money into bank on yourself plans. I have 19 of these plans, and I put 40% of my income every year into them. I really do walk my talk, and I love it. And, the reality is that we're not telling you, we're telling you to add this. We're suggesting add this to your financial plan. Make it your foundation, because all the surveys and studies show that people have no foundation. The Federal Reserve, the last survey that they did, which was just last year, they found out that most people don't even have $3,000 to cover an emergency, to pay for when the roof, you need a new roof, your air conditioner breaks, any of those things. They just don't have that. All of their money is tied up, and in my book I talk about how it's really in jail. It's tied up in these plans, these IRAs, 401ks, 403bs, and so on, where you don't have control of that money. You think you do, but you don't. The government has control of your money. They created the plan. They have control of it. Just try taking your money out when and how you want it, and you'll find out. And as soon as people find that out, usually through hard luck, they're like, I get it. Because bank on yourself is about liquidity, tax advantage, control, predictability, and guarantees. It gives you all of that.
Yeah, for anyone hearing about it their first time, or maybe they heard about it and kind of put it on the shelf in their life. But look, this 30-minute interview is not even scratching the surface. We don't even have time to get into the ways you can have this account liquid or use it to have a dual compounding strategy in your investments. You really have to go to bankonyourself.com, start the whole process. I do financial stuff every single day, and I spent months and months on this, researching it. before I even called someone to walk me through. And then I spent even more months before I set one up. And now I have one for my whole family. Pamela, I wanted to ask you, I know we're running short on time, about the IUL, because I've seen a lot of people doing a bank on yourself like, I emphasize like, but they're trying to use the IUL, and I want to know, I'm sure you've looked into this. Is it a realistic alternative, or is it something that's just taking risk into something that was perfectly fine without risk?
I would say if an advisor suggests, and IUL stands for Index Universal Life, if they suggest that you put your money in there and you can use it for the bank on yourself concept, you need to run. And if you, on bankonyourself.com, just put in the search box, equity, just put in Index Universal Life, and you'll see I spent literally several hundred hours investigating Index Universal Life. If I thought it was a good thing, I would be promoting that rather than dividend paying whole life. But you got to, I've spelled it out really, really well there, why you do need the 7 reasons you need to be wary about it. And you need to be aware too that recently there have been a number of lawsuits about this, and recently New York State's top financial watchdog launched an investigation into the sales practices used by insurance companies and advisors who promote IUL, and expressed concern that the illustrations are, quote, wildly inaccurate, and that many people could be harmed. It is a hype. It's going to fall apart, and it's not going to fall apart right away, but it will. Mm-hmm. Because and I explain all the reasons why. So absolutely not, run the other way. And I would also suggest that if you're looking for a good advisor, there are 200 advisors in the U.S. and Canada that have been trained by Bank on Yourself to make sure that these plans are structured right to your advantage. They're willing to take that 70% cut in commission. They will never, ever try to sell you Index Universal Life because they know it's a ripoff and hype. And if you go to bankonyourself.com, you can learn more about those advisors and get a free analysis and a referral to one of them anywhere in the U.S. and Canada.
That's great. Pamela, last question. One of my mentors, he always told me that whatever is on a bill in Congress, whatever it says, it's probably going to do the opposite. And I noticed on your website, you guys... on the financial IQ area, you go over the Pension Protection Act of 2006. So if you could tell us, what does this law actually protect?
Yeah, and I would suggest, so when you go to bankonyourself.com in the upper right, there's a couple blog posts up there, listed up there, and the first one listed is what's your financial IQ? You should click on that and take the 20-question quiz, because you will be shocked. And I'll tell you right now, I'm going to challenge your listeners, Daniel, because I'm going to tell you we've already had more than 10,000 people take the quiz, and only 2% got an A, only 2% got a B, 77% flunked it, flat out flunked it. And I'm going to make a prediction right now, Daniel, that because your listeners are interested in finances and they pay attention to you, that they're going to do better. But I want them to go and click on that. What's your financial IQ? Take this quiz and find out now. And so the answer to the question is, it was the 2006 Pension Protection Act that was passed. And when I ask people, do you know who that protects? Their answer is, well, I guess it protects us, investors in 401ks. And the reality is that it protects your employer. Now, if you probably noticed that more and more employers are automatically putting your money into certain in mutual funds, and that if they do it automatically and they put it in those types of mutual funds, typically target date funds, which have been proven to be expensive and to have underperformed the market significantly, if they put your money there automatically, they are protected from liability, which means that if you lose your shirt, tough. You can't go after them. That's what Congress passed a law to protect, not you.
Oh, that's horrible. All right, Pamela, New York Times bestselling author of Bank on Yourself and Bank on Yourself Revolution. Please check out bankonyourself.com, and we also accept that challenge. So I'm going to put a link in the email we'll send out as well as this video, go check out bankonyourself.com on the upper right. Let's take the financial IQ, and hopefully everybody scores well. Pamela,
yes,
again,
I hope they do too.
thank you again so much for your time. I really appreciate all the work you've done to help people.
Oh, my pleasure. This is a lot of fun, Daniel.
You have a great day.